All right. I think that we're live. Good. Well, first of all, let me know if you can hear me well. Let me know if the screen is is it good enough for you to see? Shall I zoom in a bit? And then we will get started. Hey, Lobel, thank you for joining. We'll wait for a minute or two before we dive into today's live stream. Hey, Goran, how's it going? All right, good. Thank you for letting me know, Lobel. Goran had a very nice holiday in a very nice destination. I think that if he starts sharing more about his experience, then probably most of those of you who are watching will be jealous. So let's maybe move to a different topic. So, but of course, Goran, if you want to share, feel free to do so. But I won't push you on that. Thank you for joining again. Well, today I wanted to share a bit more information about stock screening. It is something that I have been asked many times, and I'll be honest with you, I look at it maybe slightly different. Normally, what most are expecting to do is when they are screening for stocks, they want to find the stock to invest in, and I have a bit of a different approach. Basically, what I'm trying to do is I want to figure out the stocks or the companies that I want to avoid. So I'm going to Good. Thank you, Goran, for sharing. I'm sure that yeah, there were nice places to visit in yeah, great place. Nice. I guess the next step is to add pictures and other stuff to make us even more jealous. Yeah. So back to the topic. What I want to do is I'm going to share the reasoning behind one of my screens, and as you can see, there are three of them that I have at the moment. I will walk you through all three, but I want to share a bit more the rationale behind all of these. Um, Basically, it is very important before you start entering the input for screening certain companies that you know what you're looking for. So and it goes the other way. You should also know what you're not looking for. So for example, if you want to be more exposed to large cap companies, great. Then that would be one of your criteria. If you want to avoid certain countries, certain industries, just make sure that you have that well defined. Don't start with the entire universe of all companies and then try to narrow it down. Try to define kind of to some extent what you're looking for in a company, industry, the region that it operates in, maybe risks that it has, and then try to find the company that matches with that description. And of course, stock screen as a process, it is definitely interesting one as a starting point, but it is far from really providing meaningful insights because you would need to do a lot more in terms of insights and reading the reports and understanding the industry and a lot of other stuff. Now, once you know what you're looking for, then you can use whether it's Ticker in this case. I'm using that one. I think there's Finviz. There are a lot of websites that offer some sort of stock screen, and you can also look back some of the companies that are great today. So for example, if you want to look at Apple, Amazon, and you can go back 10, 15 years and figure out what kind of fundamentals did they have, what could you screen for that you end up with similar companies. And what you'll notice is that there will be plenty of companies that meet those criteria, but they're not going to be the next Apple or the next Amazon or the next Meta. And because of course the environment is different, and even Apple, Amazon, and Meta between themselves are very difficult. And to first of all identify, especially 15, 20, 30 years ago, but for Amazon especially, and they're very different between one another. So in this particular screen, what I have is I wanted to screen for small cap companies in Europe, and I have a couple of criteria. So first, I wanted the enterprise value, which is market cap, if you subtract the cash and add the debt, divided by the EBIT, the operating profit, to be below 15. It's kind of a metric that I use myself. Then I have limited the market cap to below 1 billion, and I'd like to see the net debt position. So sometimes it helps me understand if you take the total cash and you subtract the debt out of it, what does that look like? Because although every company is different, ultimately they all need to survive if at some point there is a challenge ahead of them. If they're unprofitable, if that is not possible, then obviously there's no point in looking for all the other fundamentals. For me, it's very important to have a good financial health when it comes to the balance sheet and the positions, and that it has enough capital to support the ideas that the management has. The industry, in this case, I want to see what the industry is that the company operates in. I want it to be positive net income, so profitable company, positive operating profit as well. And I want to see the total enterprise value, the margin, as well as it being above 8%. This is a metric that it's very good. The ticker already has it. I think it's a good one. It's basically EBITDA is a proxy for operating cash flow minus the necessary capex of the management plan, divided with the interest expense. It kind of shows how much it's a kind of an interest expense coverage ratio. So if a company has a very low coverage, then if there's a slight change in the interest rate, the interest expense when that is refinanced would go up, and then this ratio might be even it's not sufficient. It's below one, that the management or the company doesn't generate enough cash to support its capex and to pay even the interest part of its debt. So that is one metric that I use. But of course, if you take a look at what I'm doing now, is I'm looking for companies that are a bit more stable, I would say. I'm not looking for high growth company, not looking for, I don't know, it's a different approach. And this is one screen. It doesn't mean that this is the only one that I have. This is one that I've been using recently, and I think there are quite some interesting companies that pop out of this based on these criteria. But if you want to search for a high growth company, do that. I mean, just do what fits within your investment style. And then for the country, I had to remove some that either I would not invest in, or the brokerage company does not basically offer as an option. Then for the industry, I've removed some that I'm just not interested in, like oil, gas, and consumable fuels. Banks, I'm not really interested in. So if you're interested in some of these, just make sure to narrow it down as much as possible. And if you take a look at these criteria, which are probably like 10 or so, there are 382 companies out of 67, 68,000 that match. So there's still quite some work to go through, but it's at least for me a good starting point. And then I can sort them based on the industry. I can take a look into more detail based on what I find interesting. I can see the country. I can see all the information on one place to get me excited about a company, but not excited enough to invest. So this is really the starting point. So if you're looking for to build yourself a screener, I would really recommend to try to define what it is that you're looking for, not to start from all the companies or the entire universe, and then try narrowing it down as much as you can. So maybe you're looking for large cap companies above 20 billion. Sure. You're looking for maybe banks. You're looking for what else? It doesn't matter. It is flexible, and today we have the technology to at least allow us to narrow it down, and then it's up to you. Do the work that is actually going to take you most time. So what I have here is just the starting point again. I have two more screeners that I didn't use as much. I was interested in. The second one was the largest price movements. Basically, I wanted to take a look at companies that, for example, over the last week or month went up, let's say 100%. And then that they have a market cap of above 100 million. So in this case, you'll notice that there are 60 companies that went up 100%. This was not something that I used to invest. It was just more that I was, curious to see what happened. And sometimes there is a good reason for this. Sometimes it's behavioral, something that cannot really be explained through the fundamentals. But you can also do the opposite, right? So the stock price change is lower, or it could be negative 30%, 40%. That's also interesting for those who are interested in being contrarians, kind of betting that the market is overreacting on bad news. And if you figure out a good company that was punished to a certain event that happened, I think this is an interesting simple screener but then of course you'll need to add a lot more. So you could add, at the industry, you could add a lot more other stuff. I really like Ticker. It's very easy to use, but of course you can use any other stock screener out there. So the last one that I think is very interesting, and this is more for, I wanted to make a video on this topic. Yeah, Tizian, I honestly I did see that that Piscine de Jeu is up 6%, but still not really that big of a movement. At least, of course, closer to what I think is fair value, but hopefully it will continue to go up. I really like small cap companies. I mean, you see what happened, for example, today. A few hours ago, there was market went down like 1-2%, and suddenly everybody's tweeting about that as if that is something. I don't think that is worth talking about, so I won't spend too much time on it. But if you take a look at small cap companies, there's very little volatility, and just because they're not really covered by a lot of analysts out there. So this is why I'd like to focus a lot more on the European small caps. I think that is one place where there's not a lot of people looking at, and hopefully there will be more companies like Piscine. I think I'm up at 20-25% on the position, and it's been since September, so it's not that long. And yeah, definitely high risk, definitely. And I mean, liquidity is something that, of course, the big players are looking for, so they wouldn't be investing in a company of 50 million or so. But as I'm not investing 50 million, so for me it's not really a challenge to allocate a small amount of money. Now, for us unsustainable dividends, this is something that I wanted to make a video and probably will do at some point. But basically, of course, I'm sure that many of you know, if a company pays dividend that is higher than what it brings in as cash after it takes care of the interest, after it takes care of the capital expenditures, it's not sustainable, right? That can be done for a couple of years even if they borrow more funds, but it's not sustainable forever. It would be the same as if we as individuals or as families, we spend more than we get in form of salary or whatever it is that have as cash inflow, and you borrow from the bank in the form of a personal loan to support your lifestyle. Well, that cannot go forever unless you figure out a way to make more money. And I think that there is this interesting ratio, which is the dividend yield that a lot are interested in. And every time that they see 7%, 8%, 10% dividend yield, it somehow it seems as if they're getting 7% or 6% or 10% guaranteed, which isn't the case. And what I wanted to point out is, of course, there is a way to screen for that. I hope to identify some examples through this screen, which is basically when the payout ratio, the ratio between the dividend and the dividend and the net income is above 100%. So in this case, I'm looking for companies that have that above 150 even. And what I'm trying to do is just point out that even though the whole story is good, and yes, you get a high dividend yield today, either the company has to improve to sustain that, or it's not going to be sustainable the way it is operating. And of course, it is very important to recognize that what I'm screening now is based on the last 12 months. That means there could be a one-off event that happened over the last 12 months that pushes the net income down, and it will recover at some point. But based on something as simple as this, above 10 billion, so I'm really looking even for relatively large cap companies. I actually have, there you go, 2 billion. Then we have 270 companies. So it's a relatively small percentage. But take a look at the payout ratio, for example. Obviously, this is something probably one time that, of course, this is not sustainable. But there's probably something within the company that they had a one time a bad year or some expense that is not recurring. But I'm sure that if we filter based on the market cap, I'm sure that there are really big names that many of you are familiar with, and it's important to go through these for myself to basically create a high quality video to point out to certain companies that have a high dividend yield today, and also point out the reasons why it's not sustainable. Yeah, I agree. So the levered free cash flow yield with dividend yield, I think it's also one approach for sure. You can, I think the payout ratio is in general accept. There are different ways to approach this. What I find interesting is sometimes the companies engage in buyback schemes, or they kind of make a promise to their investors that they're going to buy back X million in shares in the next year or so. And even though that's not anywhere within the financial statements at the moment, it is kind of a promise for the next year. So there will always be these kind of additional cash outflows that we don't see, but will be there. And they will push this payout ratio significantly. And obviously, in hindsight, it doesn't make sense to buy back shares when you're in tough position. But I've seen that many times that managers, basically the management is optimistic about the future, and this is, of course, the share price is plummeting. The investors are afraid of what's coming next, but the managers are very positive, and what they do is they engage in this kind of activity. So there are always these kind of events that it's very difficult to see through the financials, but this is why this, as I mentioned, this is the first step to find certain companies and then to further look into. And of course, you can take a look at, um, for example, the PE ratio or the net profit. But using net profit as a margin, for example, as a stock screener, I think that is a very big mistake if you have all the industries out there. So if you expect, if you compare, for example, Meta as a tech company, and if you compare, I don't know, Tesla, that's not yet a fully tech company. It's still, in my opinion, to some extent, a car company. Of course, they're going to have significantly different margins. So if you have a too high threshold, you're going to filter out companies that are actually doing quite well. This is why I'm not really a big fan of setting high thresholds. Otherwise, the low margin businesses, even though they are high quality, will be completely out of the picture. How about a screener with a high dividend current yield and high last? Yeah, I mean, definitely high last 5 to 10 year dividend growth. It's definitely possible. Um, I think it's important to take the payout ratio into account, because the dividend yield on its own, it is based on the share price. Based on that, so if you compare the dividend yield, it is based on the share price, and when that fluctuates, the dividend yield changes as well. I think the dividend growth, those two can be added to what I've just mentioned. So you could have the payout ratio over time, as well as you could have the dividend yield based on the share price. Even though that doesn't really pay too much, because if the share price is 100 or 1,000 and the dividend is 100, it doesn't really make any difference. So the share price isn't really affecting the ability of the company to pay dividend. It is interesting if you want to see how that changes over time. Hey Thomas, thank you for dropping by. So it might be interesting to see that in addition to this, if you want to create some graphs, some charts, if you want to see if there's some correlation between the two. But I wouldn't say that the stock price should be included in any of um, any stock screener, particularly if you want to make a conclusion if a dividend is sustainable or not. Recently looked at the UK electric utility. I haven't heard of it. I can look into it maybe a bit later in the live stream if there's time, for sure. So great, yeah, yeah. So great growth but high debt. Yeah, we can definitely look into it. Um, Let me first maybe take a look at the outcome of the European small caps, and then we can take a look at some companies. And I wanted to do kind of a shallow financial analysis because we don't have really time to spend hours on one particular company to do a deep dive. So if I take a look at this particular screen that I mentioned earlier, there were quite some companies, and there is one actually that I found very interesting, but I didn't do a lot of additional research. It was this Estoril Sol. So I'm not sure if someone is from Portugal, but this was definitely one that I found very strange. The question is, what am I missing, right? So that is something that I'll do a lot more analysis in the coming period. But If you take a look at the company, it has a market cap of 85 million. For 85 million, it has, together with its subsidiaries, engaged in gaming, food and beverages, entertainment, and real estate businesses. Those gaming, casinos. So I won't be investing in this because I'm just not somebody who supports casinos. But it's interesting to see the fundamentals of the company, because we have a company with 85 million in market cap. Take a look at its balance sheet. It has 80 million in cash. So the net debt is close to 80 million actually, because they don't have any debt actually that's significant. So basically, the enterprise value of the company is about 13 million. So this is how much one would pay to buy the whole company without any cash or debt. 13 million. And if you take a look at the profitability, it is bringing in, and it's relatively stable other than 2020, 2021 related to COVID, but more than 200 million in revenue, and but I'd say between 10 and 20 on average million in operating income. Now it even went to 50 for some reason. So this is something that I'm really interested to understand what happened. And then, of course, a lot of that translates down to the net income, because they don't have, as you can see, a lot of interest expense, because they don't have much debt. So it seems as a company fundamentally to be too good to be true. So, for example, this is one that popped on the screen, but I'm not going to be investing solely based on the financials. I cannot imagine that this company is offered at 13 million while it generates more than that every year. So um, it's definitely interesting for me to learn more about these kind of companies, because they meet certain criteria that I'm looking for, but it's definitely not one that I would invest in right away. And I don't think anybody should be just jumping into or opening a position solely because a company popped on some screen. You see, there are 400 companies. Maybe out of these 400, I'll find 5 that are matching kind of more criteria that are broader than the financials. And by that I mean I'm looking for, of course, the financial health is very important, and to some extent this is being screened. But I'm also looking at the companies. What is it that the company does? How has it been developing over the last 5-10 years? Has there been any significant changes in the industry? So there are certain companies where not much changes, right? So earlier it was mentioned Piscine de Joyeux. Well, what they do is they build swimming pools. I mean, it's unlikely that there will be a significant revolutionary new product related to that industry. So it's going to be likely a very boring industry to be in. And I'm fine with that. But if you're looking at companies, especially the high growth ones that are probably more popular on Twitter and Reddit and all the other social media platforms, it takes a lot more time to understand the environment. And it's also an environment that changes a lot more quickly. So you need to be aware of not just the company itself, but also the broader environment to make a good call on whether that is the company to invest in. And even more important is to not only be convinced, right? You could be convinced that that is a good company to invest in, but and you could be right, but maybe that will not be the case in 1 quarter or 2 quarters or 3 quarters. So for every company that is part of my portfolio, what I have is my personal KPIs. Like, what would I like to see to confirm that my decision is right? So for some, it would be the margins. For some, it would be the number of users. For some, it would be the numbers of cars manufactured. And um, it is important to not just depend on the management's commentary, because of course their job is to provide you with the good information. And if there is bad information, uh, even that will be worded in a way to sound positive. So even if the revenue declines 10%, hypothetically, the wording that will be used is, despite all the challenges, our revenue was down only 10%, right? It still would sound positive. So I'm trying to avoid reading the commentary based on the management. I do listen to the earnings calls, but I don't I try to approach it differently, as if I didn't have any information, what are the questions that I would have asked to get a good picture of whether the company is going in the right direction or not. Adrian, do you go through all screen results individual or just look for certain key indicators? I would go through all individually until, and I do the research until I find something that is just I dislike. So for example, if I start with a certain company and I notice that, the margin, let's say the gross margin was 60%, then it became 30%, then it became 60% over a period of 5 years. It just keeps fluctuating. To me, that says that there's a lot of risk. And yes, I could investigate to figure out more on that, and I will, just for me to understand the industry. But to me, that based on the margins, I can make a conclusion that this is more risky than a business where the gross margin is, for example, fluctuating by 1 or 2%. Tizian, yes, I am also a big fan of a business that someone can easily understand. Industrials most of the time have way simpler business models and they're relatively cheap, not as overhyped as tech. I To some extent I agree. I do think that those are more simple and not as overhyped. The only thing that I will point out is those are normally businesses that are very capital intensive. There's a lot of investments required upfront, and if there's a downturn in the economy, then they are the ones that most of the time suffer because there's reduced demand for a lot of that. And when that happens, of course, the profitability significantly shrinks. I'm not saying that there's anything wrong, of course, but sometimes lower multiples are justified. And funny enough, I was speaking with, uh, I won't share the name because it was a confidential conversation, but there's a person who was more into real estate, and he was trying to justify that a certain real estate company should be trading at, for example, 10, 15 times PE. But that's not really uh, realistic for a few reasons. But the main one being the real estate market always goes through really good periods and really bad periods. And those bad periods will sometimes wipe a year or two of returns. So sometimes having for example, a PE of 6 or 7, I'm simplifying this, it could mean that they were expecting, out of the 15 years to have 1 or 2 bad years. And there's nothing wrong with that. But just keep in mind that it's difficult to uh, justify based on one number. It's really important to understand a bit more the industry, the environment, and really understand what is important to keep track of. So, scaling, for sure, they're harder to scale. I agree, Tizian. But for example, take a look at this. If you're looking at, I mentioned Meta earlier, right? If you're looking at Meta, you don't really care if they're going to open a new office, right? That's not really a big deal. What you're mostly focused on is the R&D, right? That's what will generate the next products, and what you're looking for, how much that R&D is and where is it being allocated to. Is it allocated to projects that will yield good returns? So I'm not sure here if there's let me quickly see. I'm just wondering if there's like research and development expense. So there is already a research and development expense that you can add directly to the screen. So sometimes what you're looking for is for a company that is heavily dependent on R&D to sometimes increasing R&D could be good if that goes to the right places. I'm wondering, can you also have the sales and marketing? Not sure if they have too much. Day sales outstanding. Yeah, actually, I'd like to point out to another indicator that I think is not used much, and especially when it comes to manufacturing companies, and that is inventory turnover. And I think days outstanding inventory is even, both are quite good and important to track of, in my opinion, for any manufacturing company. And maybe I'm wondering, can I illustrate this based on just simple Excel file? I'll try to do something that normally I don't go do on the fly, but I'll give it a try. So let's assume that there is a manufacturing company that has fixed expenses, and I don't know, I'll make them just simple, 100,000, right? So they have a fixed expense of 100,000, and they have a variable cost per unit of 3, right? So this is what we know about the company. Hey Vince, thank you for dropping by. So assuming that we have a company that has fixed manufacturing related expense, so I'll point out manufacturing right? So it has 100,000, and for every unit that it manufactures, it costs them $3, right? So let's assume that their capacity is 50,000 units. So this is how much the maximum amount of units. Now take a look at what's going on if they produce, and what I want to point out is the total cost to manufacture 50,000, and no company runs at 100% capacity, but let's assume there's 70% or 50%, 60%, 70% capacity, right? So I want to illustrate. So we have the fixed cost, which is always the 100,000, right? So that will remain the same. And then we have, based on the capacity, right? We have 50% times the 50,000 units times the variable cost. This is the variable cost, right? So in this case, we have, let me just, right? So this will be the variable cost to manufacture. Maybe I can also add the units. Right, so 25, 30, and 35,000. Take a look at what's going on. The total cost, of course, it goes up, right? So this is, it doesn't come as a surprise. But the cost per unit, of course, the more you manufacture, it goes down, right? So you might be wondering, well, wait a second, this is very simple, right? Obviously, there's nothing surprising about this, of course. But what's going on is, let's assume that a company can sell 25,000 units. So this is how much they can sell, right? This is they have demand for 25,000, and they can sell it for, like, the cost is 7. They can sell it for, like, selling price is $8, right? So what they do is, right, if they manufacture 25, exactly as much as they can sell, right? What happens? They'll have revenue, which is the 25,000 times the 8, right? That is the revenue. They're going to have 200,000 in revenue. The cost would be the 175, and they have a gross margin and a gross profit, right? So far, so good, right? 12.5% gross margin. Now, if you're looking at this from an analyst point of view, you might keep track of the gross margin over time. Now, guess what the management did? They said, well, wait a second. Of course, we have, 25,000 demand for 25,000, but if we manufacture 30,000, what we have is we have lower cost per unit. So now what we have is, if we are to manufacture more, the cost per unit decreases, right? So what they have now is, instead of the 175 cost on the income statement, they would have 25,000 multiplied by 6.3. Take a look at the gross margin. Now it's 21%. And does it mean that this product is more profitable? It is, but only if they're able to sell this extra 5,000. If they don't sell it, so what happens, of course, their inventory increases by the 5,000, which is the difference between the, right? 5,000 times. So now what they have is, they have an inventory of 32,000 that they cannot sell. Of course, they have this much better gross margin, right? But it doesn't matter, because they didn't really generate this 40,000. They actually have 30,000 locked in inventory. And guess what they can do? Well, they could say, well, let's manufacture 35,000. Well, what if we manufacture 35,000? And by the way, if you add the two up, of course, we get to the 190,000, which is the total cost. Well, if they manufacture even more than they can sell, they have lower cost per unit. But what happens is, the inventory is now much, much higher on the balance sheet. So this is important for manufacturing companies to keep in mind. You see that their margins are stable or even increasing, but the inventory is growing up significantly. It's quite clear what is going on. They're producing more than they can sell. They are reporting good profitability, right? So in this case, it went up from like 10, 12% to now 27%. It looks as if they made 53,000 in this case, 54,000, but they have almost 60,000 in inventory that, because there's no demand, they cannot sell. So it's a bit of a different approach to look at the financials. It's not important. It's of course important to look at the margins, but this is for manufacturing companies incredibly important. Um, if you don't look at this, if you solely look at the profitability, you are going to miss a lot. And um, oftentimes what happens is, this inventory at some point becomes obsolete because it's not being sold, it just stays in a certain warehouse and it turns bad, and or there's kind of an annual review of the quality of the inventory, the status, and it gets impaired. So this is why some companies, you'll notice sometimes there's this impairment of inventory going bad, and it's different from one company to the other, because for some companies the inventory can stay in a good position for 3, 5, 10 years, but for some it's a year. So if they don't sell it within a year, or what they have to do is they need to sell it at a much lower price, which will bring their margins down again. So you cannot have of course, in a perfect scenario, you have a company that can manufacture a lot, right? 70, 80, 90%. Obviously, I think about 70, 80% is more common, and meet the demand, and that there is demand for that. But if it is not operating, if it is not selling as much as it is manufacturing, and it is not growing as much, you need to be careful of this, and otherwise you're really going to miss a big part of the picture, and the financials would look really, really, really good, but in reality, that's not really the case. Um, and I think this is more relevant for manufacturing companies. Of course, for software companies, you cannot necessarily apply this to. There's no inventory. Again, for Meta, you don't carry. They open 1 or 3 more offices. It's not going to make a big difference. But there you're looking at other indicators, and you can have all of this clearly defined as your investment criteria, or in part of your stock screening process. Like, what is it that I'd like to see? Or maybe you could say, what is it that I would not like to see? In this case, if it's manufacturing, I would not like to invest in companies where the inventory goes up significantly. And by the way, there is also the inventory turnover, which is the cost. It should be cost of goods sold, right? So cost of goods sold. If you divide that with the inventory that they have, um, you know, you can get a ratio. You can estimate the number of days or months of inventory that they have. They can basically continue selling without manufacturing. So there are certain examples. I think it's a very simple example, and of course, when we started going through it, it all seemed very simple, right? It's a very simple math, but these are there's nothing illegal in with this. But I do think that it is slightly misleading, or unless you really follow all the financial statements to see what is going on. Um, so I think I'll keep this example relatively short. I don't know if it still qualifies as a short, but I do think that it's important to mention this one for those who are looking in manufacturing related companies. Of course, there's for example companies like Airbnb that are user dependent, that they don't have much. I mean, take a look at let's take a look at Airbnb. Probably they'll have a very high return on assets because they don't have assets, right? They don't own the places. So if you're trying to figure out a company such as Airbnb, you cannot have a criteria that is um, related to return on assets. If you have return on assets as a criteria, it's pointless for a company such as Airbnb, or I think it would be similar to Uber, right? How do you distinguish between healthy and unhealthy inventory accumulation? A lot of companies increase their inventory after the pandemic to have the ability to make up for supply chain disruptions. I agree. Um, definitely there are some unusual cases. The pandemic was definitely one of them. I think it's what I like to do is I want to compare the inventory of how that changes of the company that I'm looking into versus some of the competitors. So if you notice that, out of 5 companies, only one is accumulating, and there are some, revenue is slightly declining, while for all the rest it's going quite all right. That's already for me a red flag. So I'm trying to not look at the company in isolation. Of course, certain cases like inventory accumulation, period after period after period after period, if it continues to go up, then obviously there is something wrong and the sales are not growing. Of course, If a company is growing and the inventory is growing at more or less the same pace, there is nothing wrong with that, because it is normal. They need to produce more to meet the demand. But if it's a stable company and the inventory keeps piling up, I think then it's more likely that they have this. Uh, and by the way, I'm not saying that this is. Um, it's sometimes, of course, it is being done on purpose. But sometimes what goes on is, if they have to, if they are to reduce the capacity from 60 to 50%, they're going to incur a lot of costs. They might need to make certain employees redundant, and it's not an easy process. But it is not something that should exist for 1, 2, 3 years. If that is the case, then to me the management is not managing the business well enough. Hey Victor, what sectors look discounted to you as we head into 2024? I'm not sure if I can answer that question, to be honest. I don't try to look into sectors as such. I try to focus on more individual companies and try to see if there's anything interesting there. It's difficult to answer. I think also what will happen in 2024 or 2025, the short-term future, there will always be events that impact certain sectors more than others. And if you are a fan of diversification, obviously that is something that you can to some extent influence. I try to do that myself. But if you're someone who wants to run a concentrated portfolio, then that is something that is, basically you're accepting that the picks you make can experience both positive and negative returns, significant ones, based on an event that in some cases it's not even related to the company. I mean, a good example was what was mentioned earlier, the supply chain disruption. Of course, that impacted a lot of companies, but a lot of companies benefited from that. And being diversified, I think it kind of smooths out these movements. And the only thing that I hope for in 2024 is to spend more time on small cap companies, especially ones in Europe, to figure out if there's something else that's interesting. I have another list of about 200 companies that I follow, that I've done a lot of work, but the price is not right. So maybe if some of those come to a more reasonable valuation, why not? Happy to open new positions. But I'm curious to hear, is there any company that you find interesting? And this is a question to all of you, something that it doesn't have to meet my criteria. It could be unprofitable. It could be, biotech, something that I'm really not focused on, but it could be something that at least you find interesting. It would be better if the company is not as well known, because if we're talking about Amazon and Airbnb and Apple, there are a lot of companies out there, a lot of analysts out there that follow this. But I'm just curious to hear your thoughts, to see maybe. And by the way, one of the sources of companies to look into is this YouTube channel. I have seen. I probably have the longest list that I have is from companies being recommended from others. And that doesn't mean that I've invested in them, but I've really looked into many of them. And I think it is important to have different sources, but to look at them from a neutral starting point. So not to be optimistic about them, nor to be pessimistic. Thank you, Victor, for the donation. Yeah, in general, I honestly, this is definitely a good time for small cap. I'm surprised that there is not that much focus on small cap companies. And it is something that I've put a lot of thought into. Somehow, by the way, I understand that the large institutional companies, the investment companies, the institutional holdings, of course, they're going to focus on the large cap. They have huge amounts of funds to allocate. When that is the case, you cannot spend time, looking at 30, 40, 50 million market cap companies. But retail investors, I think we need to go into the places that are least researched. There's a lot more opportunity there than if we focus on the large caps. And I try to balance the two, because sometimes I do see value in the large caps as well. But I think I'll try to focus a lot more on small cap companies. The process is a lot more different. Like you don't have any starting point. You start with uh, the fundamentals from a different point of view. You cannot. There's no one else to check if you're going in the right direction, which is something that I see a lot of people doing. And you really depend on your ability to identify a good company or not. Thank you, Victor. GES or CHGG. GES, guess. I would not have guessed that. Let me see. I'm not familiar with this company, but I'm happy with. I'm happy to take a look at it. Yes, designs, distributes, and lifestyle collections of apparel and accessories for men, women, and children. Okay, so it's an apparel company. So before I go into the financials, this is a good example. So if you take a look at the description, it says designs, markets, distributes, and licenses. It doesn't say it manufactures. So probably it has contracts with third-party suppliers that what they do is they focus on the manufacturing and they get. So I would not expect that they have very high property, plant, and equipment dedicated to that. So that is something that it's important to keep in mind. Selecting the right small and mid caps could lead to a good value in 2024. I think it can lead to good value in it regardless of the year. It's definitely, but it is more difficult because you have a lot less information to work with. Yeah, Vince, I'm glad that you agree. It's definitely more difficult. Yeah, looking where the herd is not. I agree. The alpha is not there. It is also maybe to some it's more scary because basically you're going down a road and you don't see others, right? I think that's what I would describe it as. Well, I can take a look into crop energies after this one for a bit. It seemed way too cheap. Okay. Seemed okay. Announced to go private today by being bought from a majority owner. I bought PVH because of your analysis. It's gone up over 50% over the last 6 weeks. Thanks for that one. Please do not buy based on my analysis. Please do your own research. All the content that I create is for educational purposes. Solely for that. I'm happy when you make money. Definitely happy. That's the best case scenario. But you should take the credit for both the right and the wrong decisions. It cannot be because of you. Because what if it went down 50%? I appreciate the kind words, but it's still something that I think the responsibility, the accountability should be by you. So let's take a look at this one, right? So of course, what is expected is 2021 COVID, definitely a down year. Over the last 5-6 years, not that much growth from 2.2 to 2.7 billion. Margins improving, very good, 34 to 44%, very good. Not that far off the average, I would say, for apparel company. Now, of course, I've looked into a lot of apparel companies, so I have a feeling of them when it comes to the margins. But if you're looking at a company for the first time, take a look at some other companies that are engaging in the same activity. So if you have a company that also does the manufacturing, of course, that would be slightly different. So make sure that you're looking at comparable companies. Here, for example, what I would like to see is, for example, SG&A, like their operating expenses. And you can, of course, take a look at the difference between the 34% minus the 3%. So that is 31%. So SG&A is 31% of the revenue. And now you can do the same for the last 12 months to see if that is changing significantly. Basically, what I can see is here we have almost 10% increase in gross margins, operating margins we have from 3 to 9%. So I would say the company is spending a lot more on supporting its operations percentage-wise as percentage of revenue. So this is something to look into. I'd like to understand why is this the case? Why are they spending more on SG&A? And again, you can do that simply if you take I would say SG&A of 683 divided by the 2190. So it used to be 31% back in 2017. and now it is 944. It's 35%. So there's a significant growth, and I would like to better understand why. Is this something that, yeah, maybe they have more salespeople that are focused on selling? Is it? I'm not sure, but it is something that I'd like to look into more detail. Um, Take a look at the debt, because I thought they had. So they have. I'm looking at. They don't have much cash, about 200 million, and the total debt, probably you cannot see it from. Can I move this in a bit? I probably can see it 1 billion in net debt, so 1.2 billion. So currently they're probably not paying too much in interest, but and the debt is relatively stable. So you have a company that you can buy for 2.3 to 2.4 billion net, net cash, net debt. So without any cash, with that 2.4 billion, and it is making about 200 million in operating income at the moment, right? So I'd like to understand here what happened between 2020 and 2022 and now. Why do we have this decrease of margins? Of course, part of it is the gross margin, but this is really an important point for me to understand. Now let's take a look at the inventory, because of course, yeah, we touched upon a similar topic, right? So what we, and probably there is this have inventory turnover here. Yes. So take a look at the inventory turnover, 4.26 to 2.68. This is interesting. So they used to turn around their inventory 4 times in a year, 4.2 times. Now that is 2.68. So we have an increase in revenues of from 2 let's say 2.2 or 20% since 2017, right? So 22% increase in inventory. However, on the other side, the inventory on the balance sheet, a 22% increase in revenue, and we have about 50% increase in inventory. So it's quite clear to me that they were producing more than they could sell, probably more or less every single year. So I'm not sure why the inventory keeps piling up. And here you cannot use COVID-19 and the supply chain as a explanation, because it even happened before COVID-19, right? Now it's even worse. Like this is even the last 6 months or so, even 50 million. You mentioned you screen the cyclicals out, like oil and gas. I filter those companies out because I'm just not interested in. I that doesn't excite me a lot. And yes, I agree. There's a lot of cyclicality around it. There's also a lot of dependency on the market price and so on. So, um, I'm personally avoiding companies of that kind. But that does, again, it would be very different for every individual. So you need to figure out what works for you. There was another one you mentioned. I think it was Victor CHG. Yeah, but by the way, for this company, of course, there's a lot to do analysis. Like, I'd like to understand where do the products come from. So it would not be the same if the company is uh, in the US and the products are manufactured also in the US, if the products are manufactured somewhere in Asia or in Africa or in any other place. So there's a different risk related to that. So check, yeah, I have heard of this one. Direct to student learning platform. Let's see. Check writing as well. Check study. Check math. Study. I have not used the platform as such, but let's take a look briefly, right? So 1.3 billion in market cap. If we add the net debt, we have 1.6 billion. So this is how much it would cost to buy the entire company as a whole, 1.6 billion, and it's probably, so it was quite high growth, and especially, of course, there's COVID. Now there's a bit of decrease. Um, I'd like to understand what is this driven by, because yes, between I'd say 2020, 2021, and 2022, I would expect that there's some normalization because there's COVID-19 and so on, and at some point there will be a decrease. That's not really a big deal, but now it's a lot has a, quite some quarters have passed since, so I'm not sure. There's even a further decrease here, but also the other part is take a look at the SG&A. They are spending, so for example, 2021 they were spending for the full year, they spent 259 in selling, general, and administrative. Last 12 months, they're spending like 100 million more. They made less in revenue. So they're spending more on SG&A to bring in less revenue compared to 2021. Part of that is, of course, organic demand driven by COVID, but it's really a big jump in SG&A, and not much, in my opinion, is justified at the moment. So the question here would be, if the company is dependent on SG&A and it needs to continue to market, to reach the target audience, to me this is quite comparable to a direct cost. So you have companies like, for example, Duolingo. It doesn't need to target this users because they know the product, and if they really like it, they will have quite high retention. But in this case, if they need to retarget every single time, it's more of a recurring direct cost rather than a one-time customer acquisition cost. It's really recurring, and if that is the case, then this is something that I would pay attention to a lot, to figure out how can they decrease this over time, and can they decrease it over time, right? And if they do, is that going to impact the revenue? And I've seen a few companies where they have to maintain the SG&A, or especially the selling, the marketing expense high. I see that more often in, I'd say, service related small businesses. So for example, if you have a company that is, I don't know, fixing something within the house, I don't know, like let's say you fix water leakages, right? Or you're providing electricity service, you're not going to have recurring clients. I mean, that's ideally, right? But you will have clients who need your service quickly, and if they are in a place where they don't know someone, they're going to Google. So if they Google, basically to be on the top of the search results, you would be engaging in paid advertising, and that is, in my opinion, a direct cost, because you have to maintain the selling expense. If you cut that out completely, if you no longer promote on Google, basically you no longer get new clients. So if in this case Czech is closer to that kind of model where they need to continue target same audience for more like one-time services, then it is a direct cost, and I don't expect high operating margins. And if you take a look now, they even have like -7%, despite spending, again, a lot more on selling, general, and administrative. They have lower revenue that they had in 2021. Of course, I need to go into more detail to share more, but it's like kind of based on the income statement. That is something that I would really be interested in to see, because if the company doesn't make money, and I think that the competition around education will only increase over time, then yeah, it's really, we can also take a look at the estimates coming from the analysts. So they expect even further decrease in 2024 and 3%. So based on this, this is not a growth company, but I wouldn't trust too much the analysts, because they are most of the time really backwards looking, and they cannot put a value to what's coming next. Oftentimes, they have a certain task to identify, to look into a certain company, and when you only look at what happened, you get a good feeling of what has happened. But if you don't look at the projects that are in the pipeline, then you might be significantly off when it comes to the revenue. So if they're working on 3 new platforms and one of them is really good, then this whole assumption might be completely wrong. But yeah, it's interesting to just kind of see from it from a high level point of view. I haven't heard of the victim of AI, being victim of AI. You mean, yeah, I understand what you mean. So because there are too many AI tools, that the demand for companies of this kind might decrease. I would look at it differently. So I'm not. I would look at what the company does and the pricing, and try to compare the value that it offers, or the I'd say the value price ratio. So if I subscribe to check, I'm not sure if it's a subscription or pay by the hour, versus, for example, I don't know, ChatGPT, and is the value proposition still there, or is it really being disrupted? Because I think eventually, if there's a superior product, it will take over more market share. So it is important to really understand the company, but then this is the part that it plays a big role to understand the environment. And for example, check math. Is this something that is better than OpenAI's ChatGPT? Is it something that is cheaper? Is it like it's important to compare the value and the price for that particular service. Mm, I think I'll probably the stream for a little bit longer, but probably closer to the end. I'll probably look over the next months or so throughout these companies, and of course, some of these will change if they have better or worse financial performance. But this is just one example, and this is something that I'm currently using as one of the few screeners. I'll work on the unsustainable dividends as a side project at some point, but probably I don't know. I'll try to avoid mentioning a timeline. Currently, what I'm working on, and I wanted to point out, hopefully by the end of this year, or maybe beginning of next, is the Dave Ramsey 8% dividend, or the withdrawal rate, more accurately to be said. So he's mentioned that if you have a portfolio, you can withdraw 8% of the dividend and just live off that. And 8% is generally quite high. Normally, I think the 4% is kind of the accepted rate where you don't risk to run out of money. What I did was basically I looked at I downloaded the data from 24, I believe, and I'm going to simulate a portfolio using Python for every single year to see what are the results if you were to withdraw 4%, 5%, 6%, 7, 8%, and then um, is the 8% reasonable? Is it something? Is it a good advice from Dave Ramsey to actually do that, or would you be running out of money in less than 20, 30 years? Have you looked at any consultancy? I think they can really benefit from AI, as companies will need help to implement AI systems. I think I saw Accenture recently being very optimistic on the use of AI. I'm not sure if it would be the like purely like the big name consulting that would benefit the most, or maybe certain smaller companies that provide services, because you have to keep in mind the traditional consulting companies, they have specialists in certain areas. So they might have, I don't know, if it's accounting, they have an accounting specialist. That person not in AI. They might have, a tax specialist, that's a tax person. Maybe they have a management consulting. They could have, you know, in the legal department, they could have an expert. And those are those are really the specialists. So if any of the big consulting companies wants to take part of this pie, basically they would need to have an AI consulting department as a separate segment, as a separate department of the company, and then really have experts in that area, and then offer that as a service. But I think an AI consulting company on its own might do a bit better than one of the big ones that creates one of these departments internally. The thing is, I'm not sure if I would be investing in this. I see the whole industry as one that is quite volatile. There's a lot of things changing, and the company that is doing well today might not be the best one in 6 months or a year. There are a lot of new tools being introduced. If you take a look, I mean, take a look at ChatGPT, right? That was the thing. Now there's so many companies working on something like that. Of course, Google has a lot of data. Twitter, Amazon, I mean, these are really big companies that are trying to compete. So just because product is good and they were first doesn't mean too much in today's environment, especially when it comes to AI related products. And I think maybe the physical products, companies that manufacture, that sell physical products, they might have more sustainable advantages than AI related companies, because it's, if a company um, has the resources, then they can always hire AI or machine learning specialists and experts to create something comparable to offer it as well. I work at a boutique consulting firm, and we plan to bring in a few machine learning engineers since many of our clients are now. Yeah, I agree, and I think that's definitely will have an impact. Of course, it will not be, the revenue of the consulting companies will go up now 3 times in a very short period of time. But I think it really needs a separate part of the company to support that kind of demand. You cannot support AI related projects with the current consulting related stuff. It's a really completely different set of skills. I think, yeah, Accenture PwC is also has a separate part, so it will be interesting. I I'm not sure. I don't feel comfortable betting on one of them, only because there's a lot of new features, new products being introduced, and I don't think I have enough time to keep pace with everything to estimate what is better. Sometimes it requires to have a good understanding of the technology to distinct one or the other is better. I think all the some of the AI related tools that are being introduced are being developed based on different models, and sometimes if you want to make a conclusion of which one is better in the long run, then you need to really understand the model, and would take a lot of time in research to get a better understanding of that. So I'm not saying it's not possible. I'm just saying that is not necessarily for me. So I'm happy to follow, to see what is going on and to see how that is going to change maybe certain industries and companies. But I'm not going to be investing because one company has the best AI related product today, because that might not be the case in 6 months or a year from now. One company that I really like is Upwork. I mean, I've invested in it times now, and I mean, it's probably up 40-50%. I'm really happy about it. Of course, I've a lot of um, analysis on that. But for example, there, even though I have invested in what I think is the best freelance platform, I am considering investing in Fiverr. It's the only competitor that they have. Pricing wise, they're similar. So sometimes I might make certain decisions based on where I think a certain industry is going, and based on what is uh, happening around it. Of course, there's LinkedIn that has been, um, I think, rumored to create something similar to Upwork, some sort of a freelance platform. I don't see that going out well so far. I mean, it's been a very long time for that, and I'm surprised that they don't leverage all the members that they have to create some sort of a marketplace of that sort, where actually they get a cut of everything. They're just focused on more, I'd say, the sales navigator and all that market related or market research. And there's nothing wrong with that. I'm just saying that sometimes I will probably be sharing boring videos of boring companies that are not appealing to many of you, and you have to either follow those videos or not. It's up to you. If you find them interesting, then that's fine. If not, there's so many videos out there. Just find what you're interested in and focus on that. I'm not sure what will be the next video. I have a lot I'm working on, but of course I also started my own company, so I'm busy on different projects at the same time, and I'll be sharing my thoughts in different forms. Sometimes it would be just a post, sometimes it would be a video, sometimes it would be a live stream. I think right now we are in the sell shovels in gold rush phase, and I think a lot of companies will put a lot of money in consultants to get AI hype train. Sure, I mean, definitely you can see the AI consulting companies as the kind of the shovel. I think that is how Nvidia is being seen, right? When it comes to this whole AI boom, they were on the right side. They were right to develop the right products, best in it time, and I don't know. Maybe also AI consulting could be so. But take a look at the screen that I have, right? So if I take a look at the European small caps here, I could also add industry, and I could figure out what is the industry that is closest to what you've mentioned. So maybe there is. I'm not sure if there's consulting as such. Maybe it's software related. Can I search consulting software? Because software is also something that will be interesting. But you can try to figure out if you're into AI and you really follow that closely. You could figure out what is an industry that will be impacted by that, and then try to figure out the company that you think will perform better than the rest and why. Right? So or maybe you think beverages will be impacted. Of course, unlikely, but um, there's definitely a lot of categories here to check. I'm interested, to be honest, other than the creative side of AI, I'm really interested in how it's going to impact healthcare, because I think as a society we can definitely benefit a lot of when it comes to different researches around that, figuring out cures around certain diseases, and I've also seen use of AI when it comes to surgeries. I think that is very important. Where, for example, a friend of mine was working on a machine learning project where it was it took a lot of input, various kind of input of the patient. During the surgery, the doctor had the real-time information of different parts. I'm not sure if how to explain that better, but for example, the arteries, the veins, the muscles, and he could project a picture on top of the body, really know where the various parts, the various organs are. So it was like it would reduce the chance of the doctor making an error, and it's something that not always maybe seen as a big deal. But I think these kind of projects that do require understanding of machine learning and AI and really processing a lot of data help. They'll have definitely have a lot of positive impact. Thank you, Vince. Thank you. I'm glad you like the new company. Well, it's just the beginning, so there will be a lot of fun stuff there. I mean, I don't have really experience running a company as such, so it will be. Of course, I have my opinion, the knowledge to provide certain services, but challenges will be in the form of how do I hire the right people? What kind of a structure makes most sense for a business of this kind? But I'm looking forward to tackling those questions in the period to come. So yeah, I mean, we were speaking about the AI. There will be a lot of very important, very interesting, positive cases, and of course, there will always be the negative ones that, unfortunately, we cannot avoid. Deepfakes is definitely one of them, creating all kinds of videos that are not real and are misleading. And I'm sure that if you're on YouTube, seen some advertisements created by AI that are misleading. At the same time, if OpenAI will be able to help anyone create ML models, um, yeah. So what I've seen with ChatGPT, because I've played around a bit with it, you can create your own GPT based on certain criteria. So and you don't need to really understand machine learning. Um, I guess to some extent that is available and it does an acceptable job, but it really needs a lot of iteration and adjusting parameters. So if you don't get the response that you were looking for, basically teach the GPT that this is not what I was looking for, but this is the answer that I was looking for, and it can readjust and kind of learn from your input. So you don't really need it. It's interesting. I've heard rumors many times of a marketplace for GPTs that maybe, I don't know, maybe somebody's interested in certain area, or maybe somebody's interested in math. I mean, Chegg was mentioned earlier, right? Maybe someone wants to learn math. Well, maybe somebody will make GPT that is teaching math for the age of 6 and 9, hypothetically. So if you define it that way, you create a whole program that somebody can use to teach their children, or maybe the children can use directly to learn math. Well, that there is value in that for sure, and maybe that will be something that will be on the marketplace at some point, kind of custom generated GPTs, the same way as there's the App Store. Maybe there will be a GPT marketplace. If you ever make an investment fund, it should be called cost to capital. No, I have no intention of starting an investment fund. I don't think I ever will. I just don't see that. Yeah, I understood. Like cost of capital, like cost of capital. It's definitely close. I think cost of capital would be a good name for most investment funds out there, because it really costs the capital of the ones who are investing in them, considering all the fees that they get, regardless of the performance. I'm more of a fan of the performance based funds. Unfortunately, there are not many of them for reasons going to be sustainable, because in bad years they'll still have all the costs to maintain the portfolios and continue with the research. Yeah, it's definitely a good name. Sure. There's a new GPT that's slowly being rolled out by Microsoft called Copilot, which will be used in all their Microsoft 365 products. Yeah, I've seen that. I've recently only saw the introduction of Python programming language within Excel. I think that sounds like a good deal, but it won't be used as much, because normally if you need to run something, it's going to be more complex in Python and won't really benefit from it within an Excel. You probably need more data to run through it. So, Adrian, can AI also replace company valuations? It's interesting. I have been asked this question when I was presenting my thesis when I was in university. It's a very similar question. It was not AI, but it was more like algorithmic or algorithms by high-powered computers. And I think the answer is depending on if you're trading or investing. So if somebody is trading and you're trying to input that is some sort of really short-term signals, then any computer, and it doesn't really necessarily need to be AI. It could be just like generated algorithm, will beat any human, because they can process the information much faster. And if it takes 1/100th of a second, of course they're going to be better. When it comes to valuation, or maybe I would say investing in the long run, I don't think that AI has any advantage, because at the moment it's all processing the historical data to make assumptions, and basically base the valuation based on that. But you're going to be rewarded if you are right what is happening in the future, not what happened in the past. And I don't think that at the moment AI has advantage in the form of knowing more about the future at the moment, right? So I think for most companies, nobody knows what will happen. So it's all about making guesses, and I don't think how at the moment AI can replace or be better at investing. Hey Rick, thank you for joining. You sold out sound. I'm not sure what that refers to. And you haven't been kind over the last month or so, but it still doesn't matter. You're welcome to join the stream, and I hope that you enjoy it. I believe that the mechanics of calculating free cash flow to equity covered models, however, the assumption is going to... Yeah, so I think calculating the models, the free cash flow to equity, the unlevered free cash flow and all that stuff, the historical part, the AI can get her, right? So that's not the big deal. But yeah, the future, the assumptions about the future will be really difficult. And of course they can be populated, and what I see is there are many content creators out there that what they do is they assume that the future will be exactly the same as the past. So if For some companies, that will be the case. For the boring companies, maybe that's not much going on. But for example, you cannot use that assumption for Microsoft. You cannot use that assumption for Tesla because there's just a lot of things going on. So maybe AI can be used to create these models for boring companies where the future will be not that much different compared to the past. The growth will be similar, the reinvestments will be similar. But for the risky companies, the high growth, the ones that have a lot of uncertainty, I don't think so. I'll give you one more minute or so if there are any further questions. And if not, I'll close the stream because it's getting a bit late. It's not too late, but 20 minutes past 11 p.m. We'll have some work to do, so it's going to be a fun night, another one for sure. But yeah, I know that this whole live stream started with the purpose of sharing the kind of my approach to screen companies, and I spent a little bit of the time, maybe the beginning on that. We went to a couple of different topics on related to financial analysis and looking into parts of the financial statements. Now we are going into AI and all the other stuff. I do enjoy these conversations. I hope that you also get some value out of it. And I'll try to organize more live streams, to stream more, but only when I have something that I think is interesting to share. So I won't live stream just for the sake of live streaming. There will be a certain topic to start. And then if there is there are other questions, that I'm happy to dive into those. You could try and maybe use it as a screener or automate the boring work of valuations. You could ask AI to scrape financial statement, use historical averages, and okay, so yeah, I agree. Yeah, so everything that's related to the past, I think that is something that can be provided by, and it doesn't have to be, by the way, like it doesn't have to be AI, it doesn't have to be something super advanced. I mean, there's so many tools out there that already provide some of this. So the idea of AI is that it's artificial intelligence. There's some intelligence to it. Everything that we've discussed so far, it doesn't really require a lot of intelligence. It just requires gathering the data from the right sources, and that's it. So I I would I think I still have the same assumption. So for trading, AI could help. For investing, probably not so much. Thank you very much for joining. I wish you a very nice day or evening wherever you are, and I'll do my best to, as mentioned earlier, to host more of these in the coming period, depending on the topic. So if you have any topic to share, if you have some, um, it could be a simple topic, it could be a complex topic. I'm happy to go through, and maybe it would be interesting if there are some large acquisitions or some big events that are happening that I live stream about that and kind of share a bit more information about that. I don't know. We'll see. I'll experiment with this kind of stuff, and as long as you enjoy it, as long as there are people joining, and as long as there's positive energy and support, I'll keep doing that. Thank you very much, and as always, the next one.